day at the chart, a sea of red, talking puts and calls, but they just stare ahead. Strike price means nothing in the black minds. Margins and
Market,
leverage like mountains.
Nasdaq's up 300, the S&P's up 63, the Russell's up 35, Dow's up 555. Gold down slightly, silver down slightly, copper up, corn, soybeans, and wheat all lower. Bitcoin pretty flat, and a small little rally. And Ethereum, what do we got? We got oil is taking a breather. It's up really big last few days, and then natural gas down. All right, so that position, that Tesla position, is a new position. I put that on for you yesterday. Because it looked like we were going to be rallying in Tesla today, but did not happen. So actually you're down on it today, but it's not anything that I would change right now. I would go ahead and leave it there. I took off a lot of risk in the Russell if you open up the RTY. So this morning, this was basically open up the RTY. I can't see it. It must have froze. Hello?
Yeah,
What? I can't. What'd you say?
I had to reconnect it. It did that. See it moving?
Okay. Yeah. All right. So open up the Russell. You see how those two strikes there are 25.25 and 25.25, the put in the call, that are no longer there?
Yeah, the zeros.
Yes. That's because this morning when scroll to your left so we can see the actual prices and stuff. Yeah. This morning, this basically opened up at 25.25, and I've been adjusting this up and down kind of every time this thing has made a big move, and it got to the point where you're putting your call, we're sharing the same strike, and it was out. The put was out of the money, or excuse me, the put was in the money and the call was out of the money, meaning the whole thing had a lot of long delta and it was leaning long. Well, this morning we basically opened up right around 25.25. So I used that opportunity to basically buy the guts and sell the wings, meaning buy the straddle back and then get our risk back out of the money. So now, and you can see this has been profitable in doing all this. It was down 1,700 at that one day. I think maybe last Friday it was down $1,700, and now it's back in the green. In the green by 365. So it's a good opportunity for us to reduce some risk in here. So now your short strike is back down to the 2,400, the short put, and then the short call is, I can't read that. What does that say?
Which one?
The short call. The 2650, is that what it says? Huh? You only have two contracts there. One's a put, one's a call. What does it say?
I think it's 2650. 2400 and 2650.
Yeah, what do you mean you think it's 2650? You can't read it?
I can read it. I just know how to look at those. Oh.
Yeah, 2650C. That means 2650 call. And then November is the expiration. All right. So basically, that gives you a lot more room if this continues to rally, and it also gives you more room if we sell back off. So then we can make further adjustments. So meaning if it sells off, we'll roll down the call. If it rallies, we'll roll up the put. All right. So close that back up. We're not going to touch that. Tesla, I don't think you touch that. If you open it up and just look at what you've got in there, it's the 400 call, which means, or the 400 put. So I sold the 400 put. What does that mean?
You're giving someone the option what you're selling. Someone can buy it at that price. Giving someone the option to buy it.
No, I'm guaranteeing that I'll buy it at that price.
So when you buy something, you're selling it to someone for that price.
You sound really choppy. Where's your mic?
Right here. Hello?
Move it over close. Yeah, move it closer to you because I cannot hear you.
Hello? Can you hear me fine
Yeah,
now?
I can hear. Yeah, I can hear you now, but I couldn't hear what you were saying. You're mumbling. What? Repeat what you were saying. I couldn't hear
Oh.
what you were saying.
When you said that when you sell something, you're saying that you'll buy it at that price. You will buy it.
Yeah, when you sell a put, you're saying I will buy it at this price. When you sell a call, you're saying I will sell it at this price.
Okay.
All right. So skip snap. So basically, that's $40,000 in risk, or 30, because we collected about $9 for it when we sold it, or when I sold it. So that's $39,000 in risk. Get you long Tesla at $390. But it's only got 28 days left, and we'll have opportunities to roll it. Palladium not doing great today. It's down about $1. Not really much to do in there. That one's going to be just kind of let it go. Nvidia. So this one, we sold this to get some short delta. It definitely worked because Nvidia's up today and it's losing money. It's not to the point where I think I would touch it. MU, on the other hand, this is called getting gorilla smacked or ran over. So in here, scroll over and look at your beta weighted delta. So in here originally when we sold this, I think it was around 5 beta weighted delta. You can see now that it's almost up to 12. So that brings our overall portfolio beta weighted delta down quite a bit. Does it not? Actually, that Tesla long has really gassed up our portfolio delta because it's got 30. If we hadn't done that, then you would only have 10. So with something like this, with that big of a move, you can. So how would you normally adjust this to reduce your delta?
By selling more calls.
No, we sold a call and that gave us short delta. So we want to reduce the amount of short delta, or basically get some long delta.
So we buy. What?
No, we would sell the other side of this, the other
Sell
side of a
put?
call. Yes. So go in there and look and see what you can get for the puts. So it is, what's your delta of your call? Go check your call delta. It's about 23. Okay. And then now go to the puts and look to sell maybe a 10 delta put. Scroll back up. Go to your puts. We're doing we're doing the same thing every day. You should be picking up on what we're doing here. Go a 10 delta. No. You're looking at the call delta, not the put delta. There you go. 10 delta.
It's just confusing scrolling back and forth.
Scroll up.
All the
Scroll
same.
up. Scroll up. Scroll up. That's 26. That's 19. That's 6. Okay, now scroll back to the prices. That's 10. There's the 175. Scroll back to the prices. To the prices.
Yeah.
There you go. Sell one of the 175s. Go ahead and hit the bid in the 175. Mid price is probably 233, 232. Okay. Yep. It's not going to cost any more capital because you already have the other side on. So there you go. That was filled. So now your delta is reduced and your beta weighted delta is now sitting at 6 again. What does that mean? That means we took directional risk to both sides instead of just one side now. But we'll continue to monitor that delta. And if it gets too far off base, then we'll make further adjustments. All right, go to MP. Scroll back, look and see if MP is a winner today. MP's up pretty big, actually. Not really much to do in there. It's basically got 7 more days. And then that put will expire, so we'll have to make a decision at sometime next week on that. Applied also up on the day. Your delta in there is now down to 19, so pretty flat, but I don't think I would touch much in there. You're still down 150 in there, 160 overall. I don't think I would touch that one either. I think we still let that work. Angel Studios, nope, wouldn't touch that. It was down a little bit today. And then AG, where are we at in AG? You're down $58. Go back over to see what it's up or down today. It's down small. And this one actually expires today. So if we don't do something with this, we're going to get assigned 100 shares of AG. So you've got two options. You can either let it expire, take the shares, or you can roll this out. So go to that put, go to show details, then go to the one expiring today, then scroll up to it. And now on the put side, go like you're going to buy it back, get over to bid and the ask, hit the bid, or the ask, I'm sorry, the ask. And then minimize this, go to next week, go to the same strike next week. See if you can actually. It's a 15. It's a 15. It tells you the 15p up top. So go ahead and sell, hit the bid on the 15 and see if it's going to give you anything for that. Hit next. 11 cents. Or you could take the shares. Go ahead and hit, get back out of this. Or you could take the shares. It's currently trading at 12.75. So if you take the shares, you're down what, $60? In here, you have to go to your positions tab and see what you're down overall in this trade. AG, but down about $60. So here's what you could do is go to do nothing with the put and just move your call down to collect a little bit more credit to go against your shares that you're about to see assigned. So take the call from the 15 down to 1350 or even the 13. Let's see. If it's currently trading at 74, let's say, that means there's 25 cents till you get to 13, and then 25 plus 40 would be 60. That would only give you enough to break even. So do the 1350. So buy back the 15, sell the 1350. There you go. Hit next. Taking 20 cents to do that. Go ahead. Yep. There you go. So on Monday, you'll have 100 AG shares, and that call will just be a covered call position now. Okay. All right. This one is up today, it looks like. Yes, you're still down $60 overall in here. This one also, you're going to be assigned shares in this put. So what I would do in here is...
Ace, pipe down.
I'd probably take these shares, honestly.
By what?
I probably would take this 100 shares as well. So I probably wouldn't do anything. I'd probably leave your call exactly where it is and take the assigned shares. And then for Apple, this one again is going against you, but it's not really that huge of an effect on that overall delta. So I don't know that I would change anything in Apple just yet.
Okay.
And that's pretty much it.
Yeah.
So
good amount on here.
Yeah, we got a lot on there. We don't need to put anything else on, but go. All right. So scroll over to your right. Now explain to me what delta is.
Delta?
Yes.
I know it's Theta.
What's Theta?
Isn't it like the risk to the downside?
No.
No? It was Theta.
Theta T starts with a T. T for time. Time. Theta is time decay.
Oh. Wait, what's risk to the downside?
Delta is your directional risk.
Yes.
D for direction, directional risk. It's how much the stock or how much the option will change given a $1 move in the underlying stock.
It's like a vocabulary thing. That's why I need to write down like a vocab sheet.
Maybe you should. I mean, you could easily find your Greeks online and print out something. It's not, I mean, we've been adjusting our delta for the purpose of adjusting our directional risk, right? So
Yeah, I
whenever
understand that,
something
like, when something
so
goes
that would,
up, you want to bring it back down, like the concept, like
but that's our
selling stuff,
delta.
buying stuff.
That's our, but the reason that we're doing is that delta is directional risk. So that's what we're mitigating, trying to keep it where we're comfortable with it. Because if it gets too far in one direction,
Yeah, you have to get it back.
that means you're taking on more and more risk in that direction.
Yeah, I understand that.
And
like the definition of delta is what I like.
it does. I mean, it has a definite. The actual definition is the Greek that tells you how much an option price will change given a $1 move in the underlying stock.
So theta
But
time.
Yeah, that's per day. Your theta is option decay per day. Decay meaning how much value is going to come out of this contract, all things equal, per day.
And then
But your delta, even though it might be how much is this stock price going to move, or how much is this option price going to move given a $1 move in the stock, you can also use it differently than that. Like you can use it as a bunch of different things. You can use it as a surrogate to kind of give you an idea of what, like, how many shares you're long something. So like in AG, open up AG, we're effectively long 67 shares, even though this contract right here has 100 delta, and you're definitely going to be assigned shares. But because you have this contract that's kind of operating as a 30 some shares against these 100 shares, it effectively puts you about 70 shares long in a $12 product, or about $1,000 in risk, around that ballpark. So then something like Tesla, open that one up. So we're effectively about 25 shares long in a $400 product, or about $10,000 in risk. And that's about the amount of capital that the broker, ironically, wants you to put up in order to secure that trade. All these things come, they're all tied together. It also means if we have a 25 delta, that your probability of this being in the money on expiration is about 25%, meaning there's about a 75% chance that you're going to be out of the money. So still good. So go to the Tesla options chain. Go to the details. Does this show you probability? Open it up. Does it show you probability in the money? Scroll right or left. Do you have that on there? Go to your cog wheel. Go to type in or scroll down. Scroll down to prob in the money. Yeah, ITM, probability in the money. Okay. Now scroll over to it. Now go to your contract strike, the 400 put. 30%. So, but we didn't even need to look at that because we have the delta. We know right off the bat we're around 25, 30%. It's not going to give you the perfect number, but just with the delta, you can tell approximately your probability of being in the money. And we were within 5%. We don't even need to have all those math calculations. So people use delta as a surrogate. If I'm selling the 10 delta put, that means I have a 90% chance of winning on that trade, theoretically. Same thing with the call. That's basically another way that you can use delta. So even though really the definition of it is how much is this option going to move given a $1 move in the stock price, really how it's useful to you as an option seller, go back to your portfolio, is number one, it helps you keep your positions in line so that your expectation for when you put the trade on, you put the trade on initially for a reason. Like you think the stock is going to do a particular thing, stay within a particular range. When that expectation is no longer being represented by your position anymore, and your position's not going to pay you if that expectation doesn't come to fruition. So basically, as the stock is moving, you're either making money or losing money. So in order for you to keep a relative similar expectation on, that requires these adjustments that we're doing. So if we want to create a position that's going to pay us if a stock stays within a particular range and then we get a big down move, in order to still get paid if the stock stays range bound, we probably need to move down the call to make sure that we can still be paid. And it also gives you further protection. So we're using our delta to tell us all that information. And then we're also using our delta to tell us how much directional risk we're taking the overall portfolio. And then we're making additional trades like we did yesterday that didn't work very well, or on Wednesday, where we sold some calls to give us more short delta to kind of offset some of our long delta. Well, the market's up huge today, and especially semiconductors are rallying hard. So MU ripping your face off to the upside, and then Apple is also all of them, like Nvidia, another semiconductor stock, and Apple's just up as well. It wasn't up as bad earlier, but now it's actually starting to go against you even worse. Market's up real strong today. I mean, it's up 60 points. So that's like a 1% move in the S&Ps. But yeah, that's what delta is. And hopefully now that we've talked about it, as you can use it for all that kind of stuff, and you know where it is, you know you've got beta weighted delta on there, you know you've got your regular delta on there. You should be able to remember now that delta is directional move, and you can use it as a stock replacement to know how many shares of a particular stock you're effectively long. And you can use it as a probability of being success, or a probability of being out of the money, basically. So it's the opposite probability. If you sell out, oh, go back to your options chain. I thought you knew what that was. Go back into the Tesla option chain. Go to the current price of the stock right there. You see that line?
Yeah.
On the put side, anything lower price than that line, which is the current stock price. The line is just where the stock price is. Anything below, anything lower than that, that's out of the money. Anything above that is in the money. Same thing on the call side. It's inverse on the call side.
Blue is the out of the money and the black is
No,
in the money.
blue is in the money and the black is out of the money. So with the call, if you're selling out of the money, you're selling it above the price of the stock. With a put, if you're selling it out of the money, you're selling it below the price of the stock.
Okay, so blue's out of the money and black's in the money. No.
You just said the same thing again. Yeah, the other way around.
So blue's in the money, black's out of the money.
Yeah, we sell out of the money. We want our options to remain out of the money, because if it goes in the money, that's not good. In the money contracts are good for people that are buying them. When things go in the money and you bought the contract, yeah, that's great. But we're selling contracts, so we want them to stay far away from the stock price, out of the money, not in the money. Moneyness is the stock price where it's currently trading. That's moneyness. And we're staying out of the moneyness. We want to be away from the stock price because we're selling things we want to be worth nothing. We don't want to be in that money. We want to be out of the money. Does that make sense?
Yeah.
So the term in the money, out of the money, that's important to know. Also, there is another term that I throw around a lot on here. If I'm short something, what does that mean?
short is you're selling and long is you're buying.
Yes. Yes. But you can also use that term to refer to, so like this MU position, it has 13 delta, right? Or 6 beta weighted delta. Is it long delta or short delta?
Short.
It's short delta because it's giving us negative delta, which gives us exposure
Negative
that pays us when it goes
probability
down. So we could say, I have short delta in MU. We could say, I'm short MU. We could say, I have a short call in MU, or I'm short a call in MU. But here's where it gets real fun. If you go to Tesla, what kind of delta is this?
long.
This is long delta. But we have a short put in Tesla. So we're short a put in Tesla to give us long delta because we're selling. So just because you're short a contract doesn't tell you anything unless you have more contacts, whether you're short a call or a put. The long directional exposure comes from all of that information together. All right. So you were up a lot at the beginning of the day. You're up like $400 or $500, and now you're basically ending the day totally flat.
$26 in profit.
But at the rate we're going, by the end of this day, you're going to be down on the day. Yeah. Tesla is really kind of disappointing today, honestly. It looked like a great setup yesterday after their earnings, and just
Our natural break. Can't you see the candles rise and fall? Risk and reward, it's a game of all or no. Options open, futures closed, eyes blind. Frustrated fathers dreaming the stock grind. Explaining specs, faces blank as empty streets. Hedging positions, but the questions repeat. Time decay means nothing to the young souls in this marketplace. It's like digging holes. Iron condor flies, but it never lands. They can't grasp the feel of these trade winds. Liquidity try choking on the sand. Profits and losses, they'd rather go play bands. Can't you see the candles rise and fall? Risk and reward, it's a game of all or no. Options open, future